Well, here we are, guys. Hello, hello. Welcome to another live stream. Good to see so many people on already and enjoying the pre-chat chat. Quite a few people on. It's good to see. And we'll just keep this running for another moment or two. Special shout out to Kendra. Hope you're doing well. And welcome to the world of DFA. It's quite interesting listening and watching some of the discussion about debt-to-income ratios. I can remember when I was a banker, it would be 3 times the first income and 1 times the second, maybe. That was about it. Now it's 6 to 8 times. It's just amazing, really, how it's changed. And quite a lot to talk about tonight. A lot of data, of course. The Reserve Bank announcements today. CoreLogic's data, SQM's released data, the ABS released data. I've got my own data as well, so we're going to be data rich or data long, and we may well touch on some of those broader market questions as well, particularly around a certain US game spot company and silver possibly as well. A lot to talk about. Anyhow, it's great to have everybody here tonight, and I think we're going to get started in about 30 seconds time. Watching the numbers climb. It's good to see so many new names as well as some old names, and quite interesting seeing the bull-bear discussion on property and all the various things that have gone on there. And Leighton, Michael, thank you very much. Hello, Jason M. Good to see you too. Otto, hi there. Hi, Con. And David, I'm not sure about millions waiting, but there are a few on and around, which is good. Okay, I'm going to run the intro, and then we'll get started properly. Stand by. Well, good evening and welcome to this live stream event on the 2nd of February 2021. Martin North from Digital Finance Analytics here. Great to have you on board. Great to see so many on already, and I've enjoyed the pre-chat chat and quite a lot of people continuing to arrive, which is good. As with all of these things, there's always people coming in after a few minutes. That's fine, no problems at all. Plenty to go. I'll put a few of the conversations up as we go, just so that people understand that I'm watching the chat as we go. And Kendra, good. Yeah, you see, we are real. It's not just a figment of anybody's imagination. And as Sir Cookie says, real data doesn't lie. And I decided to get some new shirts, and so there's a few of them around. I quite like the blue one. It goes quite nicely with the background. So Mr. Negative said, you see, it just goes, you can't please all of the people all the time. I miss the beige. Very good. And no, I haven't got a spray tan. What I have done is I've adjusted the lighting on the system here, and particularly dealt with some green spill I had from the green screen, so that's why we got that. Anyway, let me now get on with the show, otherwise we're going to be talking technical stuff all evening. And by the way, there will be a new technical show coming up on the other channel quite soon about some of the things that we do. Thanks, Charlie. Yeah, good. Glad you like the shirt. So what we're going to do is go through our normal initial conversation tonight. During this part of the show, I'm going to focus more on my content than I am on the chat. So if you've got specific questions or comments you want to make, just hang off until I've done this. And it's worth saying that, as normal, the running order is this introduction. I'll cover the house rules very quickly. I just want to cover off our models because there are some new people on the channel tonight, and to explain how we do what we do. We'll touch on some key data slides, and then some questions and answers. The bulk of the show will be questions and answers, of course. And if you want to keep your questions for a bit later, I'll make sure I get to them. And we'll sign off typically about an hour and a half or so, plus or minus. It depends how deep we get into information, I guess. And just to say that this is not financial advice, I have to keep saying this. We are using data that we do from our own analysis, but I'm not a financial advisor. I don't know your personal financial experience or needs. So if you need that, go find somebody else to talk to. And please do play nice in the chat room. It's being moderated, no racial slurs. We do kick people off if we get troublesome comments. So I trust everybody to engage in good, constructive and interesting conversation. I do encourage people to share thoughts and opinions, and that's all good, but no racial slurs, please. This is as of 2nd of February 2021, if you're watching this replay. And please use @WalkTheWorld to get my attention. There's always tons of stuff going on in the chat, and I have to say that sometimes I don't necessarily sort of see everything that's going on, simply because there's too much else happening. But the fact of the matter is, if you use @WalkWithTheWorld, there's a really good chance that I'm going to see what is going on. And I see there are a few people asking about postcodes. I'll try to come back to them. Just to explain that I can see about the last 200 chat posts, but it is possible that earlier posts disappear before I see them. So you might want to hold on for later, just to be sure that I get your question answered. I do have the postcode engine online. The super chat's also enabled, and you can enable your question to go right to the top by using super chat, or if you want to make a contribution to DFA. It's a good way of doing it. It's quite simple, straightforward, and it helps us just to cover the costs of what we do. We don't make a massive amount of profit from what we do here, but it's really about sharing information and opinions, and perhaps trying to fight back against some of the rubbish that's out there in mainstream land. So that's why we do what we do. So let's just start quickly. This is my universe. So I survey households, rolling 52,000, goes into the core market model, pulling in information from lots of different areas, and that powers my research, it powers the blog, it powers the posts, and also client work. And very importantly, we can slice and dice the information in all sorts of different ways, and that helps to understand different geographies, different types of households, different property needs, and all those things. Very important to slice and dice. I keep saying you have to get granular to understand what's going on. It's really, really important. And also worth saying, I think, that the research universe also drives our scenarios, and I've updated the scenarios for tonight. That's because I think there are too many uncertainties to be definitive about how things may play out. And there are some people who keep saying, well, you said there was a 40% fall in prices. What happened? Well, it was one of my scenarios. There are many other scenarios out there too. And in terms of the scenarios and the core market model, by taking our mortgage stress, the price history trajectory, the buying and selling intentions, the migration data, both from our surveys and from the ABS, and also the broader economic CPI wages employment data, I can put that into the core market model. I run that through the scenarios, and that means at a postcode level, I can look at regions, states, and all Australia to have some thoughts about what prices might do over the next 3 years. And I'll share some of that information a bit later. Now, with regard to the RBA today, there was a statement from Phil Lowe. They didn't move the cash rate, of course, as I think everybody expected. And it's worth just going through some of the key points. So he said that they're going to maintain the target rate of 10 basis points. Going to purchase an additional 100 billion of bonds. In other words, more QE. More QE, that really is a very big sign of deflation rather than inflation. Pretty amazing, really. And they said the outlook on the global economy is uneven, has improved due to the development of the vaccine, but the path ahead is bumpy. They did say there's a better prospect for a sustained recovery, but that remains on the health situation and on fiscal and monetary support. Inflation remains low and below central bank targets, and frankly is likely to remain that way for a long, long time. In Australia, they said the economic recovery is well underway, been stronger and earlier than expected. they saw the decline of unemployment to 6.6%, but of course that is with JobKeeper still running. The true unemployment rate's higher than that. There's strong retail spending, and there's also now the question of what happens on the health front. And you can't disconnect health from economics, I'm afraid. Now, with regard to the recovery, they said that the GDP is going to be 3.5 over 21 and 22, and expected to return to its end 2019 level by the middle of this year. Well, we'll see about that. Even so, the economy is expected to operate with considerable spare capacity for some time. Unemployment rate will be higher than the past 2 decades. Central scenario, unemployment to be 6% at the end of this year and 5.5% at the end of 2022. So it'll be higher than previously. Do you remember when they said beforehand that unemployment should be 4 something to get wages up? So you can pretty much bet your bottom dollar no wages yet. And that's why they say wages and price pressures remain subdued. The CPI was just 0.9. They think that inflation is expected to be 1.25 over 2021, 1.5 over 2022. But they've no idea, and I must tell you that they're not very good at predicting it. In addition to the central scenario, they also say that if there's disappointing noise on the health front, that could delay the recovery. Important near-term issue is how households and businesses adjust to the tapering of some of the COVID support measures and the extent they use their stronger balance sheets to support spending. That's, of course, because people have been saving. Well, some have, others haven't. And they're also saying that the conditions are accommodative. There's asset prices, including house price expansion. Housekeeping credit to owner-occupiers has picked up. Investor and business credit remains pretty weak, and the exchange rate has been much higher than they would have liked. And they've basically said that they're committed to maintaining this highly supportive monetary conditions for as long as it takes, except, the normal sort of rubbish stuff. And they've also made the point that there's more funding. RBA's balance sheet increased by 160 billion, so they're following the Fed playbook. Let's just get bigger, let's do more and more QE. And they basically said that the board won't increase the cash rate until inflation is sustainably within the 2 to 3 target range. For that to occur, wages growth will have to be materially higher than it is currently. That will require sufficient gains in employment and a return to a tighter labour market. The board does not expect these conditions to be met until 2024 at the earliest. In other words, way out. So anybody who's thinking that we're going to see raging inflation and interest rates rising anytime soon, don't think that's going to be right. I think we're going to be in a deflation environment. I think we're going to continue to see this same trend where effectively central banks keep pumping. That creates more of deflationary pressures rather than inflationary pressures, and effectively we go around the houses for quite a lot longer than many people expect. But we'll see, I guess. Now, in terms of other information, very interesting information from the ABS today. People are fleeing from Sydney and Melbourne. This is actually the net migration from Sydney. Look at that for Greater Sydney and Greater Melbourne, down more than 7,000 people migrating. Some of them went to regional New South Wales. Some of them went to the regional Victoria. A lot of them went to Queensland, more than 4,000 net. Some went to Perth. And as a result of that, you can see the pivot away from Sydney and Melbourne. We've been seeing that in the data. I've been talking about this for some time. People have decided that the regional lifestyle is better. And, I'm down in regional New South Wales. I am loving being down here and out of central Sydney. I'm no interest in going back up there. And this is the overall trends. You can see there that the net migration was stronger in Sydney and in Melbourne and tailored off. Also, it's interesting to note that there were small falls in the ACT and in the rest of NT and in Greater Hobart and in the rest of WA. So you can see how this actually is playing out. I'm just going to put this comment up. Negative interest rates, yes, smooth operator. It is certainly conceivable that we're going to see negative interest rates sometime in the future. Not immediately, but I wouldn't be surprised to see it down the track. Now, look, new loan commitments rose in December. This is the ABS data. You can see there that both owner-occupied and investor loans were up. Now, remember these are commitments. In other words, this is approvals given, it's not drawn down funds, and that's really important to understand. This is distorting, I think, the true situation, but it's worth noting that the commitments for investors were a little stronger, and also for owner-occupiers, and it varies by states. You can see there, though, there are a couple of states that are actually taking off quite a lot. First-time buyer commitments also rose too. No real surprise with all those incentives. People are being conned into the market, of course. And interestingly, most of it is owner-occupied, although there's a little bit of investment going on at the moment as well. And I should note a couple of small states, they don't actually include the investment data in the statistics that are published. Business lending for property is also up. Well, that's because, of course, construction, all the incentives for building new stuff, no surprise there. This is a result of government stimulus, of course. But funded loans, this is loans actually drawn down, tells a rather different story. The growth is much more benign. And it'll be interesting to see how much of that committed stuff is actually translated into drawn down stuff. That's something that almost none of the mainstream media is talking about. And for me, that's a fundamentally important question. And here's another one. The annual RBA credit growth, this is the aggregate data from the beginning of the month, shows that housing overall was 3.54% over the last year. Owner occupation was 5.58%. Investment was down just a little over the last year. And business and personal looks pretty shaky. Personal was down 12.28% annualized. Business was up 0.96%. So you can see there that the only thing that really is supporting the economy is owner-occupied housing lending. And these are net numbers, so people are still repaying. It's interesting watching my surveys. A lot of people are actually paying down their mortgages at the moment. Now, another one is to look at the difference between the total credit. That's 1.79% as at the end of the year, whereas broad money is at 12.65%. You can see that massive growth. This is the fundamental issue we have. Massive amount of quantitative easing, massive amounts of stimulus, but it's not necessarily translating into anything particularly real. And that's why I tend to argue that we're going to see decreases rather than increases in inflation and the economy bumping along the bottom. Another picture here is the SQM, who said that listings were down. You can see there that the monthly listings dropped in Sydney and Melbourne and in Brisbane. They rose slightly in Darwin, overall down minus 2.9%. The yearly change is quite interesting as well. You can see there that listings are up in Sydney and Melbourne, 21.1% in fact in Melbourne, but down in Brisbane and Adelaide and Canberra, Darwin, Hobart. And what I'd want to point out is this change here, the listing increase and the migration are all connected, I think. And it's not as straightforward as people are thinking it might be. And just to show that, Cookie Boy sent me this chart earlier on. Thanks, Cookie Boy, I really appreciate it. 196,000 listed properties for sale at the moment and 34,000 under offer. Those numbers are both quite low. There's a lot more data I could go into, but I'm not going to in this particular show tonight. But I have quite a lot of the information from Cookie that I might incorporate in another show later. Now, prices, of course, are booming, 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 according to CoreLogic's index, and they went out of their way to talk about maximum values, etc., you know, and trying to paint a very positive picture. Well, it's quite interesting. Sure, there are some improvements in some areas. Remember, of course, that the bulk of the improvements are houses, and the bulk of the improvements are actually in smaller places, not necessarily in Sydney and Melbourne. Annualised drop is still down 2.1% in Melbourne, just 2% in Sydney, but a significant rise in Darwin, and not too shabby in Perth, Adelaide and Hobart annualised rates a little higher. But these are averages, right? And so we also know that not all properties are behaving the same. And just to underscore, the quarterly movements are relatively benign. I was watching somebody earlier on saying, oh, prices are up 38% or 28% or something. No, not true. There are small rises in some areas, but the averaging gives you those sorts of numbers. Here's another way of looking at it, and you can say that the regional centres are a lot stronger. Regional New South Wales compared with Sydney, 1.5 compared with 0.4 in the last month, same over the past 3 months, same over the past 12 months. And that's a combination of lowest levels of supply, the migration into the regions, and some of the other factors that we've been speaking about. And you can see there at the bottom, the combined capital in the past month up 0.7% compared with combined regionals at 1.6%. Over 3 months, 2.2 and 4.7, and past 12 months, 1.7 and 7.9. So regional prices up, but from a much lower base. And that is, of course, one of the critical things to understand. You've got to understand where you're coming from in terms of initial values. And this is another way of showing the same information. So a bit of a peak, actually slightly down from last month. But the gross rental yields are down, units in particular. It's a pretty shocking story. Many people are struggling with getting anybody to rent units in Sydney and Melbourne, and other places less of a problem. Houses, different story, of course, but actually units is where the pain is. And I keep talking about the gap between units and houses, particularly in the major centres. Well, this is another very good example. Vacancy rates are pretty low in some areas, for example in Perth. In some other areas they're higher, but actually you've got to look granularly. So I know that there are some places where in fact vacancy rates are 7, 8, 9%, others where it's 0.5%. Got to go granular. Home builder, of course, has had the desired effect. The private new house sales shot up by 91.8% according to statistics that the HIA presented. Actually, it's the ABS statistics. And, of course, that is because of all the stimulation and all the bribes to go and buy homeland packages. So, works as expected, except, of course, that the price of property went up. Homeland packages went up by more than the stimulus of value, as the ABS statistics that I discussed the other day shows. And the big question, which is what the National Housing Finance and Investment Corporation said in their release in December, net annual dwelling additions will decline from 180,000 to 159,000 in 2022 and will be only 120,000 in 2023. So you may have a sure hit in terms of support, but the long-term trends are still down. Now, let me just turn on to mortgage stress. So this is the overall mortgage stress number, and this is from our own data. So it's dropped back to 39.5%. It was 41.1% a month ago. So stress is easing back slightly. And just to compare that with the RBA data, 179 ratio between household debt to disposable income. Just remember, of course, that actually is completely missing the point, because only 1/3 of households actually are borrowing. So the truth is that you've got to multiply it by 3. So the typical ratio is closer to 5.5 rather than 1.79. But that's not the way they choose to report it. And across the states, here's some data just showing where the pain points are. From a mortgage stress perspective, there are 1,495,000 households in mortgage stress. So that's dropped. It was more than 1.5 million previously. And that translates to 39.47. And of the states, 53.47 of households in Tasmania. So Tasmania still feeling the pain. And Victoria as well, but not as much as previously. The stress levels are a little lower in a number of other states there. New South Wales 36, Queensland 36, and Western Australia at 37. If I look at rental stress, that's at 34.63. Hasn't moved that much actually, but it's quite interesting how varied across the states. Stress is very low in the Northern Territories and South Australia and Tasmania. And in Western Australia, that's because, of course, rents have been so low and are beginning to take up now. Whereas, of course, in New South Wales, ACT, Victoria, They've been quite high. And in Queensland, they have grown somewhat, but not quite as much. So there are still people struggling, more than, if you look at the numbers, more than 1.7 million renters struggling to make mortgage rental repayments. And this is, of course, in cash flow terms. Investors, property investors, well, property investors are actually also feeling it too. There's around 26% of property investors who have issues. A lot of them are in the ACT, New South Wales. That's where a lot of the pain is, and we'll come on to that a bit later. And overall financial stress, which is an aggregate number, and that includes all of the metrics, is more than 4 million. So more than 4 million households are still struggling with some dimension of financial cash flow. And the highest proportions are in the ACT, New South Wales, and also in Victoria. Less so in the Northern Territories, Tasmania, South Australia, but still a worrisome story, really. If I go by segments, another way of looking at the same data, and you can see there that the overall footprint shows significant stress amongst battling urban and disadvantaged fringe. So these people are on the edge of town. But the young growing families are where a lot of the mortgage stress is. A lot of first-time buyers are there too. Other segments are also represented, including exclusive professional and young affluents, but they're being hit quite strongly when it comes to property investment. So there are around 855,000 stressed property investors, and you can see there that of the distribution, more than 100,000 are young affluents. So they're people who are buying into investment properties with relatively high income, relatively young, and exclusive professionals, more than 117,000. And we've also got mainstream investors involved as well, but their stress is much lower at 26%. So overall, you can see there that the financial stress is pretty high. So this is not just one or two segments. It is actually multiple segments. Now, just quickly, I can go through the top postcodes for each of those categories. Mortgage stress. The postcode with the largest count of households in stress, 84.6% of households in this particular postcode are borrowing. In Narre Warren, 3805. Victoria does seem to do rather badly. Then we've got Lima, New South Wales at 2560 with more than 10,000. And then we go to Tapping and areas around WA at 6065. Then we go to Toowoomba at just over 9,000. And then we come back to New South Wales around Liverpool. And then we go to Victoria, Berwick and Harkaway. And then we go to Ballarat. We go across the Nullarbor again to 6030. Then we come back to Sydenham and Delaney in in Melbourne, 3037. Pakenham in Victoria, and Tarneet also in Victoria. So you can see that a lot of the outer suburban areas in Victoria are definitely being hit. And you can go down the list there to see some of the others. Cranbourne is another example, another high growth area. Derrimut, Point Cook, Werribee in Victoria, again, high growth area. And same with Craigieburn, Donnybrook and those areas as well. So a lot of the stress is in these high growth areas where a lot of people have bought recently, often homeland packages, and are struggling to make repayments. If I then move to rental stress, then you can see that actually it's Victoria, 3,000, has the highest, 12,000 people struggling to make their rental repayments. Then we come to New South Wales, 2560, pops up again, Chipping Norton, Bidwell, Marriodong, Greystanes, West Gosford, Blacktown. Then we go to South Yarra in Victoria, Toowoomba in Queensland, and Surrey Hills, New South Wales is there, Port Macquarie there, another close in Millers Point in that area around New South Wales 2000, and down to Wollongong as well. So it's not just in the major centres. Some regional areas are also being hit. So you can see that this is a big deal, and I'm still concerned about the rental profiles. A lot of these, of course, are people borrowing, renting for property investors. So not surprisingly, some property investors are having issues. And the locations where the most stressed investors are living, this means this is their location, not necessarily where they've got investment properties, include Queensland 4217, Greystanes 2145, Melbourne 3,000. So not surprisingly, if you think about it, a lot of property investors are struggling because a lot of renters are struggling. Then we've got to DY, and we've got places like Santry Point. Then we go across to Queensland again, and up to 4670. Then we come into New South Wales 2000, which includes Dawes Point, Haymarket, Millers Point, Sydney and the Rocks. And then we go across to WA. Mandurah is on the list, and there are more than 3,500 stressed investors in 6210, even with all of the so-called good news in the west. Then we go to South Yarra. Then we go to Crow's Nest in New South Wales, St Leonard's, Woolston, Starcraft, Hornsby Heights, and then we get to Queensland, Paradise Point, Labrador. Then we come back down to Surrey Hills. Then we go down to St Kilda. You can see there the hotspots. And finally, I'll just summarise the financial stress. So again, the postcode that has the highest degree of financial stress across the country at the moment is 2560, which includes Campbelltown, of course, and places around there. Then we go to Liverpool. Then we go to Toowoomba. Then we go to central Melbourne. Then we go to Mount Druitt. Then we go to Narre Warren in Victoria, Ballarat, and so it goes on. Greystanes, Cranbourne, and Hooper's Crossing, Dermot, Point Cook, Werribee. These are areas where you would expect property prices to be considerably compressed because of the degree of stress that we're seeing at the moment. And I do highlight again the need to go granular. It is probably the most important message that I keep delivering. You have to go granular to understand what's going on. You cannot just look at the average for Victoria or the average for Perth. You've got to go really granular. You've got to look at different types of property as well as different locations. So pretty important to understand that. Okay, and just to finish off my initial comments, a few other little things to share with you. The first is we're going to look at some stress mapping live. So this is actually the postcode data mapped. And basically what I've done here is the reddy colour is the highest levels of stress, and the bluey colours are the lower levels of stress, and the sort of the yellow ones are the ones in the middle. And you can see there, if we look around Melbourne, that we've got these hot spots both sides. And if we draw out a little, as we can with this particular tool, you can see there some of the hot spots there. Ballarat's a hot spot. So it highlights again the need to look at very significant footprints in particular locations. Now, if I take another example, just go 2000 first, we can do the same there. Okay, so this is centred on New South Wales 2000s, and as we pull out, you can see once again that the footprint is quite interesting. It really does show that the stress levels are different in different locations, but look at this again, high counts in the west, up around the hills, around Liverpool, and as we pull out further, you can see there around towards Campbelltown as well. I keep stressing the need to take granular views, because without it, you really cannot get a sense of what's going on. We'll just do one more. I will go over to Perth, because of course Perth would be thinking, well, you know, everything's wonderful over there, all the prices are rising and everybody's seeing, you know, the whole market rising. Well, except it's not quite that clear. There are still pockets of stress in Perth, not necessarily close into the centre of town there, but if you go north and south of Perth, you're still seeing the same footprint of hot areas. Wanneroo to the north, 6065, I mentioned that earlier on. And if you drive up or down the coast, you'll soon come across quite stressed households in different areas. A lot of the coastal strip, of course, is where a lot of the issues are. Now, I can also do the same for, let me just do this for investors. I'll just quickly show you the investor footprint as well. I'm not going to spend a lot of time on this tonight, simply because, you know, we could sort of spend all evening talking about particular postcodes and what have you. But I just wanted to show you the sort of the relative distribution of what's going on, because I think it's quite important to understand that the generic reporting of information at an aggregate level doesn't really tell you very much at all. You have to go granular. You have to really have a quick, close look at what's really going on. And as you drill down, you begin to start to see profiles that are actually quite important. So this is investor stress, right? And here, what is fascinating in Melbourne is that we have investor stress right in the centre of town. And that is because a lot of people who would have been students, international visitors, just haven't arrived. So there's a lot of vacancy rates, very high vacancy rates, and that means that a lot of investors don't have much in the way of accommodation support. You know, there are just nobody wanting to rent them. I was talking to somebody today who basically has given the property away by cutting its rent by 40%. Got somebody for 6 months and is hoping to be able to find somebody else at a better rent later. We'll see. I think it could be a long, slow grind. Let's go up to Brisbane and I'll just show you the rent situation there. This is the investor stress situation there. And once again, we see there are some hot spots close into Brisbane, particularly New Farm and in the West End. Not as significant as some other areas. You know, the colours are not so severe, but you can still see that it does vary quite considerably. And as you pull out, you can begin to see some quite interesting profiles and interesting pictures as to where stress may be. Interestingly, there's a little bit of trouble down the Gold Coast, in areas down the Gold Coast as well. If you have a look down there, you can see that quite a few of the areas below the Gold Coast are in some difficulty. And fascinating just what's going on. If you look at the so-called boom in prices in and around Brisbane, sure, there are a few houses where prices have gone up. Units, much less so. And there's a lot of stress amongst renters. So it's actually pretty interesting just watching all of this. Okay, so let me just go back to my other. Okay, so that's the stress mapping live. Now, quickly on our scenarios, just to explain, we do scenarios, of course, to consider the different futures, not because we think necessarily it's going to be perfectly right. And here is the latest. So the first is I've updated the RBA baseline based on the latest information, so 5.5% over 3 years. The home price is 15 to 30%, and that's based on that earlier modelling they did. And I've given it now a 10% probability, so that's gone up from 5%. So that is still a probability, but, 10%. Then I've got my best case scenario, which is assuming the COVID vaccination rolls out quickly, it's effective, the virus stops spreading, we open up the borders, etc., over this next year or so, and we start then international migration. So in that scenario, between plus 15 and minus 5, depending on whether you're looking at units or houses, and whether you're looking in particular regions and postcodes. That's 45% compared with 40% previously. So you can see that I've pivoted the scenarios based on the data towards those first two, whereas the longer term crunch, which I still think is quite feasible as a scenario, where the unemployment rate is at 7% in 3 years' time and house prices have fallen, that's a 25% probability compared with 40% last time. And then we've got our multi-wave. So in other words, if we get major disruption, as in Europe and in the US, and the vaccines are less effective, we could still see further falls. And of course, if there was an absolute disaster, then there would be a significant fall. But as you may know, in my central scenarios, I use the three middle scenarios. So the best case, the longer term crunch, and the multi-wave disruption as the three that I use in my modelling. Okay, now the good news is that the stress model, which I keep saying is close to being deployed, is close to being deployed. We've had a problem with the model insofar that we couldn't get it to quite do the security stuff that we needed to do it. But hopefully within the next 2 or 3 weeks it'll be up and running. So here is the model, and I had somebody ask me about 3068, so that we might just put that one in now. I noted that before. Whoops, if I could type it would be helpful. 3068. Okay, so this is like Fitzroy and places like that. We don't. Okay, so 3068, 8,900 households, 2,400 borrowing, 5,100 renting, nearly 4,000 properties for rent, and the overall financial stress is 38%, so that's middle of the road. 41% in mortgage stress, 3% in default, rental stress at 27% for 1,300, and property investor stress 35%. So there's a bit of trouble. 38% is, towards the higher end, but it's not the highest by any means. And you can see there that the scenarios for houses, in my best case scenario, we could be looking at a rise of perhaps 6% over 3 years, a fall of 2% over 3 years in my mid case, or if things go really badly, down 12%. Units, a bit of a rise, a bit of a fall, and a more severe fall. So that's the answer on that one. Okay, so I'm going to come back and just start looking now at some of the comments and see what we've got. Perhaps pick up some of the earlier questions if people threw questions at me. Let's have a look. A lot of questions, lots and lots of questions, and some have dropped off the top. So as I think I may have said to you, if in fact your request dropped off the top, you may need to request it. Here's one I can do. Let's put this one up. This is from 4552 you're asking for. Let's see whether we can do that one for you. 4552. 4552. Yep. Okay. Right, so there are about 4,000 households, 1,200 borrowing, 1,400 renting. Why did I do this? Put that back up there, you'll be able to see it. 4,100 households, 1,200 borrowing, 1,400 renting, 1,000 properties for rent, and 30% in financial stress. So the stress level is a lot lower than some other areas. 33% of people with mortgage stress, that's 413. It's not too bad. 3% defaulting potentially over the next year. 47% in rental stress at 678. 24% of investors in difficulty, 150, although 32 are in severe stress. And the projections in terms of house price movements, up 9 over the next 12 months, slight rise the following year, and then a slight adjustment back. In the best case scenario, if you take the worst case scenario, it's a fall for units. We're looking at a rise of perhaps 11% over 3 years, with again quite an significant rise this year. And this is the rises in Queensland are driven by 3 different factors. The first factor is this issue of the relative demand. As I've shown, quite a few people have been wanting to move up there. Secondly, the investment returns on investment property in Queensland is a lot higher than in New South Wales and Victoria. So quite a few people are looking interstate. And I must tell you that the truth is that many people are looking to Queensland and WA as areas where essentially there is an investment proposition. Unlike other places where in fact things are not quite so clear cut. In Victoria and in New South Wales, particularly close into the centre of town, a lot of people have high vacancy rates, and we also have a situation where people are not necessarily wanting to rent for long periods of time and are also looking for cheaper places to rent as well. So this is quite a significant factor that we're going on. Now, I must just put this one up. This was quite funny. Wow, I don't know what to say about that, but I hope the coffee tastes good. Very good. Now, here's one. Can I please discuss postcode 2200? Sure can. Let me just grab my computer, put the number in, 2200. This is Bankstown and the areas around that. Right, let me just put that back on the screen so you can see it, and I'm just going to get rid of the chat so it's not blocking it. All right, in this area, which includes Bankstown and Condell Park, 14,800 households, 4,600 borrowing, 7,800 renting, 6,000 properties for rent, more than 4,000 investors there, 46% in financial stress overall. Anything above 40 suggests to me significant pressure on prices over the next couple of years. Mortgage stress, though, not bad at 15%. Bit of default, not a lot. But look at this, rental stress, 61%, 4,829. This is one of those very important messages again, that often it's rental stress where the issue is, and that then translates through to property investors. 48% of property investors in this postcode are struggling. Net, the movement could be 2%, another rise next year, and then not much the following year. Units a bit the same actually, although I still think that units are probably going to be more troublesome than not, but we'll see in my modelling. If you take my negative scenario, you can see that the units drop by 15% compared with houses over 3 years by 13 to 14%. So there you go, that's that one. Okay, what else have we got? Just looking through some of the other comments. This is from Maz. It's quite an interesting comment. Queues of over 80 people attending open house inspections for apartments in Dulwich Hill 2203, plus timed and capped inspections of 2 minutes per person. Insane. Yeah, that's quite interesting. How much are they discounting the units is the question. There's a lot of deep discounting going on at the moment. I've seen a number of units in and around those areas that are 20% lower than where previously, and they're also guaranteeing a mortgage and also guaranteeing rental streams for 3 years. In other words, they're doing anything they can to try and get people to buy them. I suspect that's the scenario. I have to tell you though, if you do the math, it still doesn't make a lot of sense. I would not be buying investment property in New South Wales or indeed Victoria at the moment. I don't think the economics work. And of course, everybody quotes the gross rental, which is the combination between the price and the so-called guaranteed rental stream. But of course, that doesn't tell you anything about two things. One is how vacant the property will be or not into the future. And secondly, all the costs of running the property. And so net investment yield is a much better guide. And in these two areas, both in Sydney and Melbourne, net rental is horribly low. More than half of people are underwater on a cash flow basis. So they're banking on capital appreciation. I cannot see much capital appreciation happening in units for the next 2 to 3 years. Too much supply and more being built. Not enough demand, no international migration. And all of the issues relating to, for example, flammable cladding and the other cracks and poor quality construction. The post I did with Edwin last night went into this in some detail, so it's worth looking at that if you've not seen it. What else have we got? Mr. Negative made this comment. Always fun of the RBA outlook. Yeah, well, it is. You know how wrong they are? I mean, some people accuse me of being slightly wrong with my projections, although I do run these different scenarios deliberately. The RBA has just been terrible. They have not had a good run at predicting anything correctly. And, it's a bit like the Federal Reserve. The Federal Reserve spoke last week about the fact that prices, interest rates will stay low for longer. And the economy will, there's no sign of inflation, not even thinking about inflation. So they are not actually pulling levers that are actually connected to the real economy, and that's not surprising then you don't get the answers you expect. So I'm afraid this stimulus program isn't necessarily going to take us to where we expect to end up. Make this comment. There's a lot of people moving to Perth. Absolutely there are at the moment. Interestingly, quite a few people got in my surveys are moving to Perth for two reasons. One is because the COVID situation is a lot better. Well, it's gone a bit off key now, but it was previously. And then secondly, of course, prices, because they've been so falling for about 7 or 8 years, are relatively cheap compared with Sydney and Melbourne. One stage, you know, some years ago, house prices on average in Perth were higher than in Sydney. Not now. Long way to go to recover. And by the way, if you go out from central Perth, prices are still well down, and in some cases are still more than 30% off their previous peak. So the property market in Perth has not completely recovered. It might be showing a few green shoots. And interestingly, there's a lot of momentum, of course, around homeland packages, partly because, of course, the homeland packages were basically bribed, although the price of the packages went up by the amount of the bribe. A lot of people went to that. That's putting a depressive impact on some other prices of older properties in the same areas. So, again, it's not uniform across all locations. Okay. Smooth Operator says cash is king. Well, you know, I've tended to say for some time that given the current level of uncertainty at the moment, you don't want to be tied up into too many long-term things. I've also said actually that it's probably appropriate to try and get some market exposure. I said that April, May last year. And of course, markets have gone up, although how long they'll stay up is a different question. And, you know, just to have a little bit of a tease, you know, here's the old, whoops, that didn't work. Push that. If I push that, it might work. Yeah. So this is actually that wonderful stock, which has sort of went up, went down, up, down, and is going down. So not all prices can always go up. I'm not going to go through a lot of stock prices today because I don't really have time to do it. But we might do another show sometime about some of those particular prices, because it is quite interesting just watching the dynamics. Watch silver. The silver is rising a bit at the moment. I don't think silver's going to go the same way, though. I think it's too big a market. There are too many large players with very large stakes and the ability to influence the market quite differently from a GameStop. Could be wrong, but we'll see, eh? Okay, what else have we got? This is an interesting one. I heard the news say that the median price was 1.2 million. No, that's not correct according to the data I've seen. Not sure where that came from. I think it could be, that must be houses only, maybe. But the point is, very low volumes of transactions, right, in Sydney. Still very low volumes. And tendency to buy further up the market. Because a number of people actually can buy without mortgages and frankly other independent means, and of course they've got lots of cash because the markets have done quite well. That is not the full story on house prices in Sydney. And again, you need to go granular. I did a one-to-one conversation with somebody looking at Riverstone, which is northwestern Sydney, and he was quite horrified to see what I discovered. I'll probably make a show about Riverstone because it's a really good example of what's happening in that western development area, where there are thousands and thousands of new properties being built, where the land releases have actually spilled down onto the floodplains, and where lots and lots of houses are being, constructed, and subdivided old houses being resold as well. It is a disaster area. I think we're going to see lots of price falls up there and there. Okay. That was an interesting question about low vacancy rates in Perth. Is it a sign of definitive rise? Well, there's a few things going on. So remember that rents and house prices in Perth dropped dramatically, and there was quite a lot of spare capacity. It's pretty tight over there at the moment, and so people are actually paying more. Rents are rising a little, but only in some areas. I don't think it's necessarily enough to shift the whole market, but let's see a few months down the track, and let's see whether the virus pops back or whether it gets squashed again. Remember that the virus they're tackling this time is actually one of the new versions, which could be a bit more virulent. And I was listening today to what's happening on the UK, where they are now going around to everybody in particular areas where these new strains of virus have been found, and are testing everybody because they're concerned about how much more virulent this particular new strain is. We're not out of this until we're out of it, I'm afraid, even though we may like to think that we can look the other way in Australia. My own view is that there's probably still more bad news ahead on that. Which is why I run any different, or should I run different scenarios? Now, Cross-Stitch asked about rent graphs for regional Victoria. I haven't got anything to hand on that, but I may look something out if you're interested in that, and make a separate post about it later. As with everything, I can put so much data into my models and what have you, but the fact of the matter is, I suspect that rents in the regions have gone up, and I suspect rents closer into Melbourne have come down. And I'll just answer your other question here. Home builder stats may also be because of bottlenecks. Yeah, there are two bottlenecks that's worth talking about. The first is people can't get builders. That's true in WA, and it's true also in certain other areas, even around Sydney and Melbourne. The other is materials. So the price of materials, building materials, has actually in some cases risen, or you just cannot get them. You cannot get supply. So I suspect that the timeline that people expected with regard to these new home builds will be much extended, and it may kick over into next year or so. It'll be interesting to see whether the government has to change the timing mechanisms on some of those stimulus packages to take account of the longer construction cycles than perhaps previously thought. Now, Smooth Operator makes the point that crypto is going up as people speculate or try to find any way to put their money. Yeah, I mean, there is a highly speculative environment at the moment. A lot of people have been given government checks. A lot of people have money that they didn't spend on holidays and other things, so they're looking for a home for it. And of course, a lot of people have come to the market for the first time. It was interesting listening to the owners of Robinhood, which is the US trading site. They don't charge for trades. They make money by selling the data about people to other people, and also by taking a cut on some of the transactions. And interestingly, they've had to raise a huge amount of liquidity and capital to support their business because of what's going on. But what they said is they've had the biggest sign up of new investors they've ever had, and that's true in other of these platforms too. So we've got many inexperienced investors who've come in and magically seem to be winning. And the question is it really that simple? And my experience of 40 years or so trading in the markets is no, it's not that simple. There are purple patches when things go up, but there are also patches when it doesn't go up. And indeed, as Brett Hunt said, silver's crashing again. I might look at silver a bit later if I've got time. I need to go to my other computer to put the price of silver up. But yeah, I'm not convinced that it's necessarily in a really bullish run. And one of the interesting discussion points about silver and gold is whether they're a hedge against inflation. Well, if you think inflation is really going to be strong, then sure, it might be. But if you think it's going to be deflationary, in fact, gold and silver aren't really the right elements to be involved in. And also make the point with regard to silver that the industrial use of silver is quite important with a lot of the electronics areas. And so they're very worried about prices running away, and so will perhaps do all they can to try and pull it back. And of course, a lot of large holders of silver, and there are a small number of investment banks and other players who hold vast amounts of silver. They manipulate the market all the time. So silver and gold are both highly manipulated markets. They are not free markets. And the relationship between the underlying amount of silver that's out there and the total contracts that are there is remarkable. There's way more contracts than there are actually underlying. And what that means is that people take positions and then close them out, take positions and close them out. And if they go too far from the central point, then the margin calls get too large. So they'll always want to try and pull it back towards that central price. Those prices are absolutely being manipulated, and that's why I'm sceptical of whether we're going to see a massive run-up in silver. Could be wrong, but that's just my view. And Peter made this point: high interest rates make cash more valuable to hold. You can get earnings on bank equity. Well, interesting. So if you put money in the bank, of course, you get pretty much nothing now. And in fact, more banks have changed the terms and conditions. If you look carefully at the bonus interest rates, it's now not on the total amount, only on the first 100,000 or whatever you've got, if you've got a large amount. It's very hard to get any good returns. The thing I think to highlight is I suspect bank shares will be doing quite well. Three reasons. One is they're getting this really, really, really cheap funding from the RBA, which means that they can lend it on cheaper and still make a turn. Secondly, the volume of loans is up, as we showed, and that also makes quite a lot of difference. And the third is, of course, the changes to some of the lending standards means that they've got probably more flexibility and less chance of being sued for poor responsible lending standards. So I think that the local banks here in Australia, unless we get a really big international crisis, will probably do better than many analysts were saying a few months ago. But hold on to your hats with regards to bad debts. Not bad debts necessarily from mortgages, that won't work out for some little time, but I am quite concerned about bad debts relating to the SME sector, because of course SMEs are now losing further support, particularly with regards to JobKeeper, and what that could mean is that a number of them will ultimately end up having to foreclose and shut down, and it'll take some months for that to work through. I was talking to somebody who works in the insolvency sector quite recently who said, look, it's been very, very quiet, like there's been crickets for months, but suddenly life is starting to stir. Suddenly businesses are coming in and saying, well, we're not sure we can trade our way through this, what should we do? And of course, every time there's a lockdown, there's another sort of flood of small businesses. Tourism sector might get some further support from government, probably right, but a lot of other businesses won't and haven't. And my frustration has been that JobKeeper went to the big end of town, many of whom made massive profits, didn't go to the right areas of business, the small businesses who really needed it. And unfortunately, many of them will ultimately go to the wall. My surveys of SMEs still show huge amounts of distress, so that's something else to watch. Now, let's watch this one here. Let's have a look. Here's an interesting question. Postcode 6666. Now, is that a real postcode or is that a made-up postcode? I don't know. Let me just try and put it in and see what happens if I do that. Right? 6666. Hang on a moment. 6666. No results found. So that's not a real postcode. So I don't know quite what you what you're playing at, but no, good try. Okay. Ben asked an interesting question here. What will a potential liquidity event do to property prices? Wall Street bets tank the market. Yeah, I mean, it's really hard to know precisely how all this plays out, right? Essentially, property prices here are way higher than they should be. That's still over 40% long term, right? If you look at the long-term ratios, that's where they should be. The reason they're so low is because of credit availability and very low interest rates. And the Reserve Bank the other day, again, reiterated, and that was a paper that Peter Tulip published some years ago that said if you cut rates by 100 basis points and keep it there for 3 years, prices could go as high as 30%. So that's one of the reasons why I've got that scenario in my model. Doesn't take account, though, of ability to repay, and it doesn't take account of the other economic drivers and the loans and the fact we've got big loans and all those things. So liquidity, if it dries up, will have an impact on the banks and the banks' ability to fund themselves. It will have an impact on the broader economy and the economic momentum, and it may even have an impact on inflation. It's hard to know how this all is going to play out. Very, very uncertain times. Right, what else have we got here with terms of questions? Taffy, thank you very much for that. Really appreciate the super chat, and we've really. I like the little icon as well. That's great. Thank you very much. Okay, can I do postcode 2200? I did 2200, didn't I? I've done that. Yep. So I've done that one already. So I need to do that one again. Okay, here's an interesting one from Cross Stitch. Filling areas in Queensland with 75% of mortgage stress, full of retirees and brand new houses on 200 square metres. The retirees would be fine. It's the new houses on subdivided land. Sure, yeah, that's partly true. But interestingly, quite a few people who've moved into retirement have moved into retirement with mortgages. If you go back 10 or 15 years, people would pay off their mortgages in their sort of 40s or 50s or, towards 60s. And so they go into retirement without a mortgage. That's less true these days. And interestingly, if you look at some of the areas of Queensland where people moved up for retirement or in the Central Coast, there are significant numbers of older people who still have mortgages and are still required to make the repayments. Now, the other factor, of course, is that many of those people are reliant on term deposits. And what's happened to term deposit rates? They've gone through the floor. So many of these older Australians are actually being squeezed because they're still having to make those mortgage repayments, and sure, rates have come down a bit, but they're also struggling with very short amounts of returns from deposits. And then begs the question, well, what do? Do you pull money out of deposits and put it into the market, take some more market risk and try and get a higher return? Some people are doing that. The Reserve Bank is encouraging everybody to move into the market, take more risk. But the trouble is about moving into the market and taking more risk is you're moving to the market and taking more risk. And of course, in the current environment, nobody knows what's going to happen to the financial markets. They could go on up for the next 2 or 3 years, if the quantitative easing process can work, or it could crash. I'm still picking September this year as a potential point where in the cycle it could drop back down again. Could go a lot sooner than that, and I suspect we're going to see very high levels of volatility in most markets over the next little while. Now, all of that comes back then to, so what do retirees do? Well, they struggle, they hunker down, but they are actually in financial stress, and I see that in spades. So, it is partly the land and package thing, but it's also the fact that many older households are actually now in more difficult territory than previously. And interesting, if you look at the distribution of where all those savings are, a lot of the savings are actually in particular segments, particularly more affluent households, particularly people who, didn't really get hit particularly badly by the lockdowns. Whereas, in fact, there are other segments where the amount of impact from the lockdowns and the fact that incomes are being squashed and they're moving to part-time work has had a huge impact. So it's not uniformly spread. Okay, what else have we got? Let's get rid of that for a second. This is from Sir Cookie. Markets are a little shaky. Most have hit the wall. Something will have to give. Long overdue for a correction. Pretty much what I've said, Cookie. But it could happen, quite soon. I know Harry Dent is saying he thinks within the next month they're going to see significant drops. I'm tending to think it could be later than that. And I wouldn't be surprised to see further run-ups. Remember the amount of quantitative easing. Remember the fact that Biden is going to be probably passing a bill to put more stimulus back into the real economy in the US. We know that the UK is going to be putting more stimulus in to support the economy because they're locked down at the moment. We know that the ECB is also doing more stuff. There's a lot of money flowing around the system. And as I highlighted earlier on, the Reserve Bank's going to do more QE here. So, this magic money machine process could go on for quite longer. It's not actually necessarily helping the real economy, of course, and that's the thing I come back to again and again. You need the real economy to perform. You need innovation for the future. None of that's happening. So this is all going to run out of smoke down the track, I think. Okay, what else have we got? I was looking to see what other questions. Lots of interesting two-way discussions going on, but not anybody asking me questions, which is interesting. Okay. Right, so I think I'm up to date. Postcode 2289 says, whoops, missed. QE coming, says Vanessa. I agree with that. And Brock said 2289. Let me try that one for you. Hang on. Whoops. $2289. Yeah. There you go. I'll just get rid of the chat so that we don't. Okay, so this is an area including Adams Town, Garden Suburb, Highfields. 2289, 7,800 households, 3,500 borrowing, 2,500 renting, 1,900 properties for rent, and 2,900 investors. 25% in financial stress. So it's a very low stressed area relative to some others. It's typical, we find that in some of the regional areas. It's just nowhere near as crazy as closer in. Mild stress, 1,394, which is 39%. So that's, enough to notice you've got it. Very, very little rental stress, only 3%. And quite low investor stress. So as a result of that, I'm looking at prices up 4%, 6% or so over 3 years. So there's definitely a potential rise in my best case scenario, or a slight fall. And some units, not a huge number of units, but again, a slight rise. So that's sort of the way that one pans out. And I've got another question from Anthony. Let's just put that one up, Anthony. There we go. Can you show 3219? I sure can, hopefully. Let's move that and then put that into there. 3219. Okay. Okay, 3219, a Victorian postcode. I'll get rid of the chat so you can see it. 9,500 households, 3,300 borrowing, 4,400 renting, 3,400 properties for rent, and 1,800 investors in the area. Financial stress 64%. That's quite high, as you'll see from some of the relativities that we saw earlier on. 2,400 in mortgage stress at 75%. So mortgage stress is definitely a big issue in and around this particular postcode. I'd also make the point that the risk of default is a little bit high. Rental stress, yeah, not too bad, but not great. 71%, so that's definitely an issue. And the investors, well, around 33% of investors are in difficulty. And you can see there that there's a small projected rise over the next 3 years, up 2.7%. These are cumulative numbers over 3 years, but potentially a fall this year in our best case scenario. Worst case scenario, there's a significant drop, down 15%. Units, not huge amounts of units there, but some. Again, a small rise, but potentially a fall depending on the scenario. So it really does come back down to the scenario that you think may play out. And there's another one that I got asked for. 3030. 3030. Let me just highlight that. And this is from that one there. Can we look and compare postcode 3030 and 3352? The answer is yes, we can. Now, I do have a little compare tool. It's part of the feature set for this particular tool. Let me see whether I can just grab it. So let me go to the compare tab. Okay. We're looking postcodes. So let's put... lost it. Sorry. 3030. 3030. Whoops. 3030. Okay, so that's the first one, and then the other one was 3352. Should I type 3352. My keyboard's getting a bit sticky. It does get a lot of use. All right. So I'm now comparing those two, and you can see there that one's Derrimont and the other one is Inverness. And you can see there that the mortgage financial stress, rental stress, investor stress is a bit different. Let's just go through the numbers. So there are more households, of course, in 3030, significant. So 36,000 relative to 6,000. There's 19,000 borrowing in the first one, 3,000 in the second, 14,000 renting compared with 1,600, 10,900 renting, 1,200, and investors 10,000 compared with 1,300. The overall stress level, though, is quite interesting. 39.2% in Durham and 53.3% in Inverness. And then if you look down there, the mortgage stress is quite high in that regional Victorian area. The rental stress is higher, 44.8% in 3030, and the investor stress is higher, 22.8% in the 3030 postcode compared with the 10.2% in the regional one. And compare the two, so effectively my modelling suggests this is sort of the base case scenario, so the mid one, is a bit of a fall, a bit more of a fall in A compared with the other one. If you take my more positive numbers, then the fall is less. And the charts below just show the relativity in terms of the investor stress, the rental stress, the mortgage stress, and the financial stress. So there we go. Hope that has helped. Okay, let's go back to the camera and see what else we can find. How's the dogs doing tonight? They're being very quiet. Maybe they're up to no good. No, they're out actually, the dogs are out with Jill tonight. So I took them out a bit earlier and sorted their needs, shall we say. So they're quietly sleeping upstairs at the moment. So I don't think they're going to appear tonight. I will say that I do have the camera set up just in case they do appear. So, just in case, I thought I'd be prepared. But so far, they haven't actually emerged. And I don't think they will now, as we're 9:14, 9:15, so we're quite close to the end of the show. They will appear again, and it was interesting. I did a couple of shows, as you may know, about the dogs, and interestingly, I had some quite different reactions. So we'll probably do a few more of those. We might put them on the other channel rather than the economic channel. Okay, now here's an interesting one to talk about. Any chance you can do postcode 3340? Love the name. Her money, her purpose. Very good. Let me just do that. And if I go 3340, yeah. Oh, it ceases to amaze me that I trip over postcodes I didn't know about before. It's quite interesting, isn't it? Okay, here we go. So this is 3340, which includes Bacchus Marsh, Glenmore, Parwan, Romsley, 8,000 households, 4,200 borrowing, 2,800 renting, 2,100 properties for rent, and 1,400 investors. 45% overall financial stress, 55% in mortgage stress, 2,300 households in mortgage stress, 2% on default, 40% in rental stress at 1,128, and 21% of investors. So it really is a story more of mortgage stress and then rental stress. And price expectations, well, 5.3% over 3 years is my sort of mid-case for houses, slightly more for units, not a vast number, but some in the area. And if you follow my other scenarios, then there are slightly more likely to be falls. All right, what else have we got? SG asks, can I do 3056? Sure can. I'll tell you a little story in a second, because I tried to be very clever. I thought I'd get a KVM, a KVM which switches the mouse and the keyboard from computer to computer, and thought I'd try one. Failed miserably to work, so I'm back with my 3 mice, and it is quite interesting. I sometimes pick up the wrong mouse, so I apologise if I do that. But anyway, it doesn't work too badly. 11,772 households in Mrs. Brunswick, 3,100 borrowing, 7,000 renting, 5,400 properties for rent, 3,500 rental property owners, so quite a lot of investors, 59% in financial stress overall. Within that, mortgage stress at 56% of 1,500, rental stress 48% at 3,400, and investor stress at 57%, 1,700 stressed investors and 249 severe stressed investors. So that's why the financial stress number is quite high. Now that then translates to house price growth. Well, over 3 years, if you're lucky, you might get 3%. Units slightly higher, but nothing much to write home about. Falls in my other scenarios. So I think the key to understand this particular postcode is the degree of financial stress that exists there. Right, let me just put that back on. See what else I've got in terms of can I do 3165 from Danielle? Yeah, should be able to. Let me just pick that up. 3165. Look it up. Okay, let's just go back to the screen again. Get rid of the chat so it doesn't get in the way. 10,900 households, 4,800 borrowing, 3,500 renting, 2,700 properties for rent, 3,700 rental property owners, 30% financial stress. That's quite a lot lower than the previous one we looked at. 1,000 in mortgage stress at 20%, 30% in rental stress, 1,000, and 32% stressed investors, overall 30%. And price rises, well, we're looking like 3, 5, 6.6% over 3 years in terms of houses, slightly higher for units potentially over the same period. Another one come up here. A lot of Victorian requests tonight, which is good. 3041. Strathmore. Okay, so 3041, 4,900 households, 1,900 borrowing, 1,700 renting, 1,300 properties for rent, and 1,300 rental property owners, 44% in financial stress, 61% in mortgage stress, 3% looking at default, 32% in rental stress, 33% in investor stress, and the price growths 4 to 5% over 3 years in the best case scenario, quite closely matched for units and houses. Now, let me just go back to the chat here, because I noticed there were a couple of people who thank you very much for the super chat. Appreciate that. Her money, her purpose. Thank you for that. Not quite sure that I understand the comment there. I'm stumped. But anyway, thank you very much for the super chat. I appreciate it. It all helps. Okay, what else have we got? Okay, Toby's asked for a postcode. 7017. Can do that. Let's go to there first. 7017. No, it didn't come up. 7017. It just now come up. Yes, interesting. We had a slight pause on the was on the network or what it was, but anyway, we got there in the end. Let me just put this up so you can see it. There you go. 7017 Tasmania, 2,200 households, 1,300 borrowing, 474 renting, 363 properties for rent, 808 investment property owners in the postcode, and 57% in financial stress. So that's quite high. 84% in mortgage stress. So mortgage stress is a real issue in Tasmania. That's a combination of relatively high mortgages relative to income. And of course, a lot of income is tied to tourism. Tourism is a real problem over there at the moment. 3% default. There's no rental stress I could see, and very little investor stress. And we're thinking that prices could be up 5 to 6% over 3 years. Units about the same. So there you go. What's that one? What's the time? 9:23. Okay. Now this is an interesting comment from Cookie Boy, or Sir Cookie Boy, I should say now. Touch of forelock. Still finding a lot of property listings with reduced prices and or big losses on the cards. Banks will be busy buying those duds. Yeah, there is still something very interesting going on. And I have to say that all of this spruiking, gets to me eventually. Well, it doesn't get to me. It makes me annoyed because people are not actually really understanding what's going on. Sure, there are a few prices where things have gone up. There are lots of discounting going on. A lot of people where people have been forced to sell. We're going to see more of that after March when the interest and principal holiday finishes. And I've spoken to a number of people who've been encouraged, quote unquote, by the bank to put their property on the market because they financially are going to be unable to make their mortgage repayments later on in the year. And of course, the banks don't want to foreclose, but if they can put enough pressure on people to actually make them shut down and close their property down and sell it, then the bank can win. So that's the plan, I think. So I agree with your comment there. All right, G-Lo asked about 2037. 203, well, come on, 2037. Glebe Forest Lodge. Okay, 8,300 households. Put that up so you can see it. 8,300 households, 1,500 borrowing, 5,900 renting, 4,500 properties for rent, 2,500 property investors, and 82% financial stress. So that's the highest we've tripped over tonight in our various examinations. 89% in financial stress, mortgage stress, and 588 in severe stress. So that's a very significant number. More than 3% likely to default, 70% in rental stress, 75% in investor stress. So this postcode is looking quite wobbly, and that sort of translates to this. Even in the best case scenario, I'm predicting that prices will likely fall over the next 2 to 3 years, which is interesting because, of course, I've shown you many others where prices have gone higher. True for units too, so prices are likely to fall here because of this degree of stress. NIFI, whoops, I saw that. Where was that? That's that one there. Okay, another question. Let's go back to there. Esperance 6450. Six, 4, 5, 0. Did I get that one right? 6450. Bandy Creek, place Esperance. Yes, it is the right one. I always try to check first before I embarrass myself. My typing is not as great as it should be, really. Okay, 6,300 households, 1,800 borrowing, 3,200 renting, 2,400 properties for rent, 1,900 investors, only 12% in financial stress. So it's a relatively benign environment over there. 12% in mortgage stress with 222. Only 6% in rental stress and 20% of investors under difficulty. And we're predicting 10% rise in properties in my best case scenario for houses this year, slightly tail back next year, and units looking relatively strong as well. Of course, if you follow my other scenarios where the virus is more active, and given what's happening in the West at the moment, that might be worth considering. But nevertheless, relative to some of the other ones we've looked at tonight, that's a pretty good story. 9:27. We're close to 9:30. I'm just going to do a couple more, and then I'm just going to close out the conversation. So Aussie 713 asked for postcode 4161, which we can do. 4161. Alexandra Hills. Yep. There you go. 6,000 households, 3,500 borrowing, 1,800 renting, 1,400 properties, and such investment rental properties, 690 investors, 63% stress, so it's quite high, 78% in mortgage stress at 2,700, and 2% defaults, 54% in rental stress at 1,000 and a bit, and just 11% of investors. So it is a mortgage stress story. Nevertheless, expectations are for an 8% rise in prices over the next year, slightly higher the following year, and over 3 years, 8 to 9% higher than where they are today. units, a bit the same. Okay. Casino Riot says 3450. So I can do that one for you. 3450. Okay. Let's get rid of the chat. 3,500 households in Castlemaine, 1,000 borrowing, 1,400 renting, 1,100 properties for rent, 875 investors, and 30% in financial stress, 50% in mortgage stress at 523, 25% in rental stress, and 22% of investors stressed. Price growth, looking at 6% over 3 years in the positive for both units, 6.7% for units, 6% for houses. Right, okay. So I think we're pretty much there. Let's just put this one up. Thanks for making Kendra's night and answering everyone's questions tonight. See you same time next week. Yep, we'll be back next week. That was for his brother. Okay. Oh dear, I'm getting all these requests now for more postcodes. Look, what I'm going to do is I'm going back to the main show and just finishing off my slides. And if I've got time, I'll run over and do a few more postcodes at the end. Okay. So let me just go back to. Whoops. We'll go back to that and put that back on. Get rid of that. Okay, so the stress modelling, which I've shown you tonight, is nearly ready for deployment. And hopefully in the next 2 to 3 weeks. But you can get all the data that I've shown you tonight for all postcodes. It's still available as a special offer under my Patreon channel. Those who logged up and signed on last month will get all of the data for February, which should be coming through in about 2 or 3 days from now. Now I've made this show. If you want to get the full data set, including all those price projections and the stress data for more than 2,000 postcodes, go across to the Patreon channel, sign up for the $50 a month. You only have to sign up for a month if you want, just to get the data. I'll be sending it out, as I say, in about 3 to 4 days. This is just to illustrate what you get. So it's a bit the same as I showed you with the online tool. But you put the code in and it shows you the information there as well. Now, the other point to make is that the idea is that those who signed up under the Patreon will be the first ones to get access to the online tool. And I would expect to be able to get the online tool up and running and available over the next 2 or 3 weeks, but it depends on the developer. So as soon as it's available, you'll get an email. If it's March, then I'll still continue to make the information available via the Patreon through the spreadsheet in the process. I will just make this point. New Zealand viewers, hi, if you're listening. Data today showed that 53% transfers were higher in Auckland compared with last year. So the market in New Zealand is going absolutely crazy, crazy, crazy. And interestingly, overseas owners selling New Zealand residential properties at twice the rate they're buying. So something weird going on over in New Zealand. I need to do another show on New Zealand. I just don't have time at the moment to do it, but I will get to it, and I will talk further about the craziness in New Zealand, because I think we can learn a lot about New Zealand. I think Australia's following the New Zealand trajectory in terms of home price growth. I also make the point that I made a show yesterday on the responsible lending debacle. There's this inquiry that the Senate's running, closes on the 3rd of February, relating to the National Consumer Credit Protection Amendment, supporting economic recovery bill 2020. In fact, this is the responsible lending removal. And so I did a submission earlier in the week, and I made a show about it yesterday. There's still time if you've got a spare hour to send a submission in, basically saying it's stupid removing responsible lending protection. Consumers need protection. The Royal Commission said don't remove the responsible lending situation. The fact is the responsible lending is critical, and yet the fact of the matter is that basically consumers are going to be left to fend for themselves, and APRA will be policing the banks based on financial stability, not responsible lending. That's a nonsense. So if you've not seen my show, go watch that show. And as I say, closes on the 3rd of February. There may be some hearings after that, so I'll keep you informed as to what happens. More information about my channel, go over to walktheworld.com today. You can also find information about the funds that I run with Nucleus Wealth, both for super and also for general investing. Plenty of information there if you want that. If you want more about me and what I'm doing, or if you want to send a request for postcode information, go to the DFA blog. URL's there, and you can send me a message immediately, and I'll come back to you over the next day or two. If you send me a postcode, I'll send you the information for a specific postcode, just like I've shown you tonight. You can also consider using my one-to-one service. I do quite a few of these at the moment where you can have an individual confidential discussion. Can't give financial advice, but I can talk about my data at a very granular level on a postcode and look at the underlying trends. I can look at stress, home price data, all the rest of it. You can book a time, Zoom conversation or a phone conversation up to an hour, and there is a fee simply because it takes a lot of time and effort to do it. I will be making a few more spotlight shows based on the data that's available, booking about 3 weeks ahead at the moment. And if you want to make a contribution just to help me, you can do that via PayPal, or indeed you can even do it via Bitcoin. There's my QR code. And if you want to buy merch, we do have some merch. I'm in the process of refreshing that, more on that another occasion. There's also more Work the World stuff, a new channel, the Work the World Productions channel. There's more than 80 subscribed to it now. We're going to be putting some more shows up there, including some more technical stuff on the models and also on the studio. So that's beginning to form quite well now. And next week, just to say that I'll have Chris Bates on. Chris Bates is a mortgage broker, and it's from the mortgage broking front line. I think it'll be a really interesting conversation given everything we're seeing. So mark your diaries on there. All right. So for those who are still with me, we're about after 9:30 now. I'll just do a couple more postcode queries, if I can find my postcode tool, which is there. Okay. Can you still buy the DFA mugs? You can. They're still available on the channel there. Just go to the follow the merch, or you can get it from YouTube, or you can get it from my blog directly. Now, there were a couple of questions. Okay. Michael wanted a postcode. 2540. I can do that one for you. So we're in overtime now, folks, so I fully understand if people disappear, and don't wait for me to sign off, but I will just do a couple more postcodes, seeing as I've got the data here. Okay, so this is that one there. Get rid of that. 25,400 households. This is Basin View, or a long list there. You can see St George's Basin. 6,200 borrowing, 13,000 renting, 9,700 properties for rent, 11,000 investors, 47% in financial stress, very little mortgage stress at 3%, significant rental stress at 64%, and 46% of investor stress. Nevertheless, looking for small rises, 4 to 5% over the next 3 years, both units and houses in that particular postcode. Another one. 2161. Sure, can do that one. 2161. It does that. Okay, 2161 includes Guildford, Old Guildford. And 10,000 households, 3,600 borrowing, 5,000 renting, 4,000 properties for rent, 3,700 investors in the area, 49% in financial stress, that's quite high, 29% of mortgage stress, more than 1,000, 51% in rental stress at 2,700, and 1,300 investors, which is 43%. And you can see there that we had small growth, 3.8 to 4% over the next 3 years based on the current scenarios. Units, not so much. And another one I've just seen there. Whoa, go there, go there, go there. Okay, Nick has asked for 6166, which I can do. 6166. I don't quite know why it's a bit laggy, but anyway, we'll look at that later. 6166, which includes Coogee. 3,800 households, 1,700 borrowing, 1,100 renting, 851 properties available for rent, 1,263 investors, 50% in financial stress, 46% in mortgage stress, 803, 67% in rental stress, 751. Quite a few of those northern postcodes, Northern Beach postcodes are in some difficulty. I think it's north, isn't it? I think so. Just trying to check. Anyway, I've seen quite a lot of the rental stress north and south of Perth. And 33% in investor stress. A lot of investors, of course, in some difficulty. But a bit of a rise, 5%, then a bit of a slower momentum over the next couple of years is what I'm seeing. Units and houses somewhat similar. Okay, I am done. I am cooked. I have done my best to cover as many comments and just watching a few of the comments there. Yeah, I agree with Jason there on responsible lending. Love the new graphics. Thank you very much. Yeah, we know we're trying to improve things. Quite interesting things going on. And sleep tight, everybody. I'll wish everybody pleasant dreams. Thank you for spending some time with us this evening. It's good to see everybody. I haven't been able to cover all the postcodes. If there are ones you want, as I say, you can always send me a message from the website and I will answer. And David, I haven't got time to answer that question now, but if you send me a message to the DFA blog, I'll put together a comparison for you. Just want to say thank you, everybody. Good night. And it's great to see so many on. We'll be back next week. And thank you for all your support. Thanks for all the messages. And I am looking forward to speaking next time. And I want to wish everybody a very happy evening. And we'll see you next time. This is Martin North from Digital Finance Analytics signing off. See you next time. Bye, folks.